Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Excited to have a new guest on the program today. His name is Mike Durose, and he's a professional geologist, the CEO of Mining Research Group. Michael, welcome to the program.
Thank you very much, Colin. Nice to be here.
Yeah, you have a great understanding, and you've done a ton of research on the gold price and its relationship to the general equities as it stands today and historically, and of course the gold equities and the performance they have against the underlying asset gold and also the general equities. We've had an exciting start to 2016. The last month has seen the HUI index go from about 100 up to well over 160 today, which is pretty indicative kind of move that you get off the bottom after capitulation type selling. I guess my first question for you is, what do you think at this time is driving the interest in gold and this rebound that we're getting?
Yeah, there's a lot of factors, but generally as an investment thesis for gold and gold equities, what's interesting about gold is that it's a negatively correlated asset class, both to broader equity markets as well as the U.S. dollar. And as you know, in conjunction with the gold price moving significantly higher since the beginning of the year, as well as the gold equities, we've seen a very major sell-off in the broader equity markets around the world. And so I think people are looking to diversify their investment portfolios, and part of that move involves moving into gold and gold equities.
Traditionally, we were talking about this before. For those interested in the gold equity space, it's well known that money typically flows into the largest market cap companies like Barrick, Newmont, Goldcorp, Yamana, and we saw that start. But very quickly, it started trickling down to what we can call the mid-tiers and the cream of the crop juniors. Many of the companies that I follow, you could qualify as micro-cap stocks, and they're starting to firm up the bids. They haven't really caught a bid yet. From your historical research, is this a normal start to a bull market?
It very much is, Colin. And in fact, what tends to happen is that when money starts flowing into the sector, really at the margin, the money that's going to drive the equity values much higher come from the generalist investors, not so much the specialized resource funds. So in my experience, I worked as a mining analyst for 15 or 16 years. My experience meeting with a lot of generalist investors is that what they look for are bigger companies, the senior, more liquid names that would fit into their investment portfolios. So typically what you'll see is these investors starting to invest in the larger companies like Newmont or Goldcorp or Barrick Gold, and then they start to trickle down into the intermediates and the junior producers as they make money in the senior names. So, this behavior is very sort of typical, and certainly what we're seeing right now. We've done a lot of work looking at the valuation of gold equities. In fact, at MRG, we have a database of about 160 gold mining projects fully modeled, and probably about 26 or 27 precious metals companies from Barrick all the way down to emerging juniors. And based on our work, we see that there's a very significant valuation spread among the various tiers of companies. So, for example, we think that the seniors are trading in the range 1.5 to 2 times net asset value, whereas a lot of the junior and emerging situations are still trading at significant discounts to their asset valuations. So in this way, there's a nice valuation spread among the seniors and the juniors, and this sets up a nice kind of consolidation environment, which typically tends to happen.
Yeah, and Mike, I want to ask you about this bear market in relation to the ones of the past. We have an eerily similar situation to what we saw in 1996 to 2000 in terms of the duration and the decline of that bear market, relating to the gold equities, of course. This time we had about the same time period of 4 to 4.5 years of this bear market, and the decline was actually, by some metrics, a little bit worse than we saw from 1996 to 2000. So my question for you is, do you think that we're setting up for another one of these epic bull markets like we saw coming out of 2000, which lasted to 2007, and an extension of that to 2011? And what do you think might differ in this bull market for gold and gold equities?
Yes, Colin, I do think we are setting up for another major move into gold and precious metals. During the 1997 to 2001 bear market for gold, basically a lot of capital had left the sector and had gone into technology stocks. This was led primarily by the internet paradigm, which was supposed to create a lot of productivity efficiencies for companies based in the United States, which ultimately led to a very strong U.S. dollar. As you know, as the dollar strengthened, the gold price went down. However, that all changed in sort of 2001, 2002, during the so-called peak of the technology bubble. Once the bubble burst, everything reversed in terms of the U.S. dollar going down and the gold price going up. So this led to a lot of capital flows moving into precious metals and certainly drove the gold equities higher. The Federal Reserve's response to this was to lower interest rates, which really set the stage for the next bubble, which was the U.S. housing bubble. So as U.S. rates went down, people could, get loans and mortgages for very low prices, and basically that caused housing prices in the housing market to rise rapidly, and ultimately that collapsed in 2007, 2008, leading to another rush into the gold market. So what's interesting is we put together a chart looking at high yield spreads over that entire period. We note sort of three major peaks, one in 2002, which was the technology bubble, one in 2008, which was the housing bubble, and another one that we've just seen now in 2015, which is the commodity market bubble. And, people have been waiting for the so-called capitulation phase, and these indicators, to us at least, suggest that we have hit that capitulation phase, and now money is starting to move back into gold and precious metals.
Yeah, well, I appreciate your response there, and it seems like many, if not all, of the factors that cause these big swings up and down in gold every few years is a direct factor of government intervention. And one guest we've had to the show a couple times, and we'll be getting him back in the coming weeks, is Doug Casey, who always talks about the idea of speculating, which is simply trying to profit off of government stupidity or policy. And it sounds like the environment that we're about to go into, which makes sense, is caused by all of this cheap money that's been coming out of the Federal Reserve. Is that the case?
Certainly, we've got a really interesting chart looking at the volatility of the gold price since about 2005. And this would apply not just to gold and precious metals, but pretty much to all asset classes. As central banks have lowered their rates to near zero and in certain cases now negative rates, this has caused investor behavior to become somewhat erratic. People are looking for returns, and so they'll invest wherever they think they can generate those returns. So a consequence of that is these kind of boom-bust cycles that we've been seeing over the last 15 years or so. And certainly, if you look at the price of gold, for example, in 2005, 2006, 2007, the actual price tended to trade in a very narrow sort of range. But sort of post-2007, we've seen these very large swings, in the price of gold. And it really, to me at least, reflects a lot of the macro backdrop, which is that people are looking for returns, and so they're moving in and out depending on where they perceive the best investments to be. We've certainly seen that in the broader equity markets as well. So, for example, one could argue that over the last 3 or 4 years, the really strong move in the S&P 500 has really been related to the fact that investors have seen just opportunities there. But now that we're sort of peaking out in that area, people are swinging back into areas that have not seen a lot of joy for the last few years. And so I think that's partly what's going on here. We're still in a very volatile sort of investment climate, and as a consequence of that, prudent investors should be very well diversified. And I think gold being a negatively correlated asset class is certainly one area where you want to have exposure.
Great. I think we've talked about this a little bit already in the interview, but it's worth touching on a bit more, and that is the leverage afforded by gold equities in a gold bull market. And the reverse of that, of course, in a bear market, the declines being far worse in the equities. You've done quite a bit of research on this, and I don't want to quote the numbers, I'll let you do that, but you were talking about a 1% move in the price of gold historically is related to X% in the equities, and what you see happening in the past decade having been a little bit different than that.
Yeah, it's a great question. Historically, based on the work we've done, since the early 1970s when the gold price was basically free to trade on its own, every 1% move in the price of gold would lead to about a 2 to 3% move in the gold equities. And that's both in bear markets as well as in bull markets. What's been very interesting, though, based on our research anyway, is that for the last bull market in gold, which lasted from 2000 to 2011, the gold price increased about 500%. But the gold equities only moved about 350%. In other words, the gold price, the physical price of gold, actually moved more than the equities during the last cycle. And, there's a number of reasons for that, but I think fundamentally it was really related to the introduction of new investable products for generalist investors, including gold ETFs, which could give them direct exposure to bullion through the exchanges. And but what I've noticed, though, since the beginning of the year is that the price of gold is up about 15 or 16% year to date, whereas the gold equities are actually up about 35 to 40%. And so we are starting to see that 2-to-1 to 3-to-1 ratio, at least in the early stages of this bull market for gold. So that's very encouraging.
Great. Well, we talked about before the interview that you might mention a couple different companies that you're interested in. We didn't get into any specifics, so I don't know which companies that you want to talk about, but I think our listeners are always interested to have pointed ideas in terms of what is interesting to you and might be interesting to them. Where are you looking to invest capital, or what's the most potential? What's got the most potential upside from this point in the market as far as you're concerned?
Sure. Well, we have a very large database of precious metals companies. Currently, we have about fully modeled up about 26 or 27 companies, everything from the senior producers, including Barrick, Newmont, Goldcorp, et cetera, to junior and emerging situations. And based on our work, we think that the average price to net asset value multiple for the industry is trading at about 1 times net asset value. Historically, the range has been anywhere from sort of 0.7 to 0.8 times NAV to as high as 3 times net asset value in a very strong market. We think that right now the senior producers are the most expensive, followed by the intermediates, the juniors, and the emerging juniors. What tends to happen in terms of investor behavior is that money flows into the senior names first, as I mentioned, followed by intermediate and then junior companies, and then finally emerging juniors. I think the most upside is going to come from the emerging junior situation, where you've got people that have scoped out a project and are working towards building it to production over the entire cycle. In the near term, I think that you're going to find money is going to flow into the senior names still for now. The one that looks least expensive to us would be Kinross Gold. In the intermediate tier, there are some really good companies that we like, things like Detour Gold with a very large gold asset, Detour Lake, up in Ontario, Canada. Very large gold mining company that seems to be turning the corner in terms of really getting its operations to hit its stride. We also like some of the emerging situations, such as Caminac, a company called Gold Quest, which is in the Dominican Republic, has a very interesting project that they're working on with significant exploration potential in the district. And so those would be a few of the names that we think might be worthy of a good look.
Based on the companies that you just named, it sounds like you have a lot of interest in what Rick Rules deemed optionality, getting invested in a company with a large asset and the market's not appreciating it due to the price of the underlying commodity. You're also mentioning net asset values. What is the number one factor you're looking at when you're valuing and deciding where your money should go in the sector?
Well, there's a couple of factors, actually. Number one is always management. I like to see, management teams that have a good track record, having a lot of integrity, and have skin in the game. So we look for companies that, with management teams that actually own a large position in the company. The second thing that we look at is, the ability of a company to execute on their strategy. So they have to, have a strong technical team. And lastly, we look at the quality of the project. And certainly, optionality is actually a very interesting concept. I mean, ironically, it's some of the lower quality assets with large gold resources in the ground that can have very large moves as the gold price moves up because of the optionality factor. But when you're looking at companies that are running real businesses, you have to really look at the quality asset and make sure they can generate good free cash flow once the mines are up and running. And certainly the capital structure of the company becomes very important when you're looking at that sort of aspect.
All right. Well, Mike, I really appreciate you coming on the show and sharing these thoughts with us. It's a great time for gold stock investors, gold investors. It looks like a changing of the tides for 2016, which has been much waited for the gold bugs out there. Mike Durose, everybody's a professional geologist. He's a CEO of Mining Research Group. Mike, last question. Where can people go to find out some more information about what you're doing?
Sure. They can go to our website, which is miningresearchgroup.com, and certainly just send us an email. All the details are there.
Great. Thanks so much for coming on the show, Mike.
You're welcome. Thanks, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?